Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. We've just released our second half 2023 India Market Outlook titled Keep Calm and Carry On. In today's podcast, we summarize our macro views for the second half of 2023 and views on bonds. We entered 2023 with a positive view on India's macroeconomic fundamentals amid a challenging global macroeconomic backdrop. So far in 2023, India is one of the only large economies to demonstrate resilience, with most high-frequency indicators pointing to a sustained economic growth momentum. We expect India's economic growth to track above its long-term trend and stay ahead of its major peers in 2023. In our assessment, fiscal policy is likely to remain the main driver of growth for the rest of this year, as financial conditions are likely to remain tighter than normal. The measures undertaken by the government, which includes greater public spend, long-standing reforms related to taxation and labour, and providing incentive boosts to manufacturing and infrastructure, is likely to boost India's medium-term growth outlook. Further, a likely peak in RBI's policy rate could drive a pickup in consumption demand. Coming to our outlook on inflation, we expect India's consumer price inflation to trend lower in 2023 and track within the RBI's medium-term target range of 2% to 6% given high base effect, easing commodity prices, and the lagged impact of monetary policy tightening. In our view, the RBI's decision to keep policy rates unchanged in its last two policy meetings and subsequent lower inflation prints likely signals an end to the policy tightening cycle. However, we remain mindful of the key risks to a positive macro outlook, which can range from global growth slowdown, persistent high inflation, and escalating geopolitical tensions. Now coming to our views on bonds, bond yields rose for most part in 2022, which impacted the performance of bonds, resulting in 2 years of muted returns from bonds as an asset class. In 2023, bond yields have continued to trend lower, especially in second quarter of 2023. Overall, we maintain a neutral stance on bonds, as still attractive absolute and real yields are counterbalanced by below-average yield premiums, stretched medium-term fiscal position, and weak government bond and demand-supply balance. Within bonds, we have upgraded medium and long maturity bonds to overweight as we see an improving risk-reward given the following. 1. Attractive real yields despite the recent rally in bonds, with the 5-year and 10-year Indian government bond yields trading closer to the 10-year average. Second, lower likelihood of policy rate cuts by the RBI in fiscal year 2024, given the RBI's focus remains on withdrawal of accommodation amid still elevated inflationary pressures. And third, strong demand from institutional investors, which includes mutual funds, banks, and insurers. We now prefer high-quality corporate bonds or AAA rated bonds because we see a favorable risk-reward relative to government bonds due to the following reasons. 1. They offer an attractive absolute yield. Second, spreads are likely to narrow amid improving corporate profitability and strong demand for bonds from high-quality issuers. And third, the returns are less likely to be impacted by changes in the RBI's policy rate stance given the cushion from higher yields on offer. In our view, the RBI's decision to keep the policy rates unchanged in the last two monetary policy meetings indicates the likelihood of bond yields being closer to their peak. We expect the 10-year Indian government bond yield to likely trade in the range of 6.75 to 7% over the next 12 months. However, there are three factors which remain unfavorable for bonds. First, fiscal deficit is likely to remain high over the medium term. Second, worsening government bond demand-supply balance given high supply of government bonds amid a lack of support from the RBI. And third, above-average inflation is likely to exert upward pressure on bond yields. That's it in today's podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you for listening, and if you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.